There you see a chart and it says look at historical record, and you see a chart and the chart has 4 asset classes. Inflation is not really an asset class, so let's look at the 4 asset classes. We have a small company stock, we have large company stock, we have long-term corporate bonds or government bonds actually, and then we have T-bills. So when we look at this graph, we see that, well, what is this graph telling us? We see, well, if let's say your grandfather or great-grandfather invested $1 in large company or large cap stocks, companies like, let's say, Microsoft, Facebook, Walmart, he or she would earn about $2,533. So $1 would go to that amount. $1 would grow to about $13,000 if he or she invested in a small cap stocks, and then $65 if he or she invested in long-term government bonds, and of course corporate bond would be somewhere in here in the middle. And then finally, if he or she invested in Treasury bills, he or she would earn about $18. Okay. So the question now is, and I'm kind of confident that many of you can kind of guesstimate or make an educated guess, is why would anybody choose an asset class that's different from small company or small cap stocks? Why would they even consider investing in large cap stocks? Why would they even consider investing in long-term government bonds, corporate bonds, or even T-bills? So what is the answer to that? Yes, go ahead, please.
Risk default.
All right, so risk. We all know what risk is. Hopefully, the probability that future cash flows may not be as certain. Again, that's risk, uncertainty. So if you look at the graphs over here, we see that, well, again, large company stock and small company stocks, you can't really eyeball and say which is riskier, because both of them are kind of jagged, going up and down in an erratic manner. But if we compare, let's say, small cap stocks versus we have over here Treasury bills, we do see that the Treasury bill graph is like a smooth line. Smooth meaning not very volatile, but jagged meaning quite volatile. So, but again, if we magnify it, maybe we can see the difference in volatility, but we need statistical measures. One of the most popular measure for, again, calculating riskiness or volatility is known as standard deviation, okay? So if we plot it, so the next graph shows you, well, let's look at the risk and return profile, and we see with large company stocks, we have standard deviation of about 20%. Small company, we have a highest return and about a highest level of risk or standard deviation. Long-term corporate bonds, again, as I said, in between 6.2 and 8.6. And long-term government bonds, we have that. And then finally, we have Treasury bills. They earn, again, they yield the lowest return, but also at the lowest level of risk. So if you look at these distributions, things become a little clearer for you. Well, for small company stocks, you see that, well, obviously the variance and standard deviation are very high. But if we compare that with US T-bills, we see that they're clustered together. If we, again, plot the series of returns and make a scatter plot, that those returns are going to be, clustered together, versus small company stock return going to go here and there and everywhere. So let's learn again. We have learned that risk and return go hand in hand. Theoretically, the higher the risk, the higher the return that investors would demand in order to be compensated, and that's what this graph is showing you. If you look at one end of the spectrum, we have the T-bill smooth curve, meaning the returns are not very variable; they're just clustered together. Versus if you see small and large cap, we would notice again the returns are quite volatile, they're going haywire, they're quite erratic. Again, if you just imagine a scatter. So these are not particular stocks, but these are based on indexes and overall return of the indexes, overall historical performance of indexes over time. Okay. So let's now, well, again, eyeballing is not going to take us anywhere, because again, we can just look at graphs and say, well, probably, again, if we look at the pink line and the green line over there, so pink and green or blue and green, we can tell, well, of course, the green line, the Treasury bills are much less volatile because, again, it's smooth. But if you just compare these two, we don't really know which is riskier just by looking at it. So again, let's learn. You might have learned how to calculate, again, return and standard deviation in another class. But let's learn, how to calculate return and standard deviation of returns of a series of returns. Okay. So let's look at this. So we have this. One, let's say this is just stock or security ABC, and we have a 5-year return. We want to calculate, let's say, again, the mean and the standard deviation. the mean, as you may know, is nothing but the arithmetic average. Okay, so how do you calculate the mean? Obviously, you know probably from high school. Add everything together and divide it by n, where n is the number of observations, right? Standard deviation, however, is a little more complicated because it calculates what's known as the deviation from the mean. Okay. So for standard deviation, we have again one series. So we first calculated the mean. The mean turned out to be, again, when we add them all together and divide by 5, which is n, we get a mean of 11.28%. This is the formula for the standard deviation. So it's xi, which is again each return, minus x bar, which is constant or fixed, which is the mean, square it, okay, and then divide by n minus 1, because we are more concerned about sample standard deviation. So this is what we have done over here. That and that, minus it, all right, minus xi, minus x bar, square it, xi minus x bar, square it, xi minus x bar, square it, add them all together, all right, and divide by n minus 1. So this is the formula for the variance. If you want the standard deviation, we have to square root. So the standard deviation is the square root of the variance. So on your assignment and on the exam itself, I'll ask you, calculate the variance and calculate the standard deviation. So you have to remember one thing. You have to remember that the variance is sigma square or s square, and the standard deviation is the square root of that. So okay, so again, manually, this is how we're going to do it. That's the formula. The formula for our average is just summing all the observations together and dividing it by n. And the formula for our variance is that, and the formula for the standard deviation is the square root of that. Let's go down and talk a little bit about probabilities. Okay, so I'm sure you have heard about probability at one point in your life or the other. We use probability in our life all the time, subconsciously or consciously. Probabilities came into being when people started playing cards, or when poker originated several hundred years ago. They didn't even call it probability at that time. But normally people who would make money, they had, they were good at math. They could, again, guess who has what card and make money based off of that. But again, it's a statistical concept. Probability is a number in between 0 and 1 inclusive. 0 meaning the probability of something, an event occurring is, 0. 1 meaning there's 100% probability that an event is going to occur. But again, normally probabilities are in between 0 and 1. It's not 0, it's 1. Well, again, if it's a 0 probability, that means, well, probably something not happening at all. What we calculated over here, when I gave you the numbers, all right, what we calculated over here and what we calculated over here was historical return. Okay, so these are historical return. We can easily download the data from Yahoo Finance or Facebook or Walmart, and then calculate the returns if you want to. But these are called historical return. They're, kind of backward looking. They're based on the past, and they're based on information that has already occurred. So they're called what's known as ex post return. So ex post return again, ex post. That means that, the returns have already been observed. So we have 2001, 2, 3, 4, 5. These returns have already been observed, and therefore we can use these returns, plug them in the calculator, and then finally calculate what the return is going to be. How much return did I earn, or what was my return over 5 years, or 10 years, or 15 years. But sometimes we might want to calculate the return, we might want to forecast returns, right? So we might want to know, well, what is our expected return going to be 1 year from now? All right, so how do we do that? Well, one of the ways we can easily do it is by, applying the concept of probability, okay? So let's look at this. So again, this is ex post return. When I'm giving you historical information, you plug it in the calculator and you calculate the return. That's again ex post return. But what if you want to forecast return? Well, when we want to forecast return, we're going to use this formula. Okay. So return or expected return is called ex ante return. So ex ante means we want to forecast some return. Ex ante or forecast based on probability. So I have an example here. The example says, well, we're given the following: 25% probability that you will make a 40% return, 50% that you will make 10%, and then finally 25% probability that you will lose 20%. How would you calculate the expected rate of return? Again, expected meaning, what is our return going to be in the future? Well, this is the formula. So we have expected return equal probability in state 1 times the return in state 1, plus probability in state 2 times return in state 2, plus probability in state n and return in state n. You have to remember, however, the probabilities have to sum up to 100% because you can have more than 100% probability. Let's look at an example on how to, and I'm going to update this as we go over. Desktop, X40. We only have exams in October. The first exam that we did last year was this. You can try this at home. We have year 1, year 2, because we don't have a whole lot of time. We already did an exam, but you should be okay with it. Okay, so calculate again mean and standard deviation. You can try this at home. What about expected rate of return? Okay, so we have, let's say we have something like this. These are the probabilities. I'm going to highlight it, make it a color. All right, so let's do a green highlight, and we have the returns. Again, green highlight. So these are the 3 states. We could have a boom state, we could have a normal state, we could have a recession state. So now, how do we calculate the expected rate of return? Well, the formula again, as you see over here, P1R1 plus P2R2 PNRN, okay? So this is probability in the boom state, right? This is the return in the boom state. Probability in normal state, return in normal state. Probability in recession, and what is that? Return in recession. So we do P1, that times that times that, and that times that, and we have, add them all together, sum them all together, and we have a return of 11.5%. So again, when we are trying to forecast returns, when the probabilities are given to you, you just do it's an easy formula. All right, I'll open up the formula because it is in the handout that I gave you.
Will we have the probabilities and the returns, or we're going to have to look for the returns?
Right, so this is the formula now. This is your equation 2 that you have in the handout. Expected rate of return. Whenever you see probabilities and returns, you would multiply the probability in that state, just like we had over here. We had a probability in boom state, return in boom state. We multiplied that. So 30 times 15 is 4.5, 50 times 12 is 6, 20 times 5 1. We add them all together, and we have 11. How do we calculate portfolio risk and portfolio return? Well, I'm going to ask you to calculate portfolio return because it's pretty simple. And this is the formula for calculating portfolio return. So if you look at this, and if you look at the formula that we just did, you see that, well, this is RP, it's return, rate of return on the portfolio, and it's the weighted average of, the weights of security 1 times return of security 1, weight of security 2, return of security 2, and weight of security 3, and return on security 3. So what are the weights? So let's define weights first, but let's first compare this formula to that formula. Okay? So we have this formula and that formula. This one has probabilities, right? We just did that. And this one has weights, as you can see. So this one has weights. So we have weight 1, weight 2, weight 3, and weight 4. So let's go back to our handout that I've given you and that I made for you, and let's look at the formulas, okay? And let's do some simple examples. So we have equation 4, how to calculate portfolio return. Again, so you have different assets. You want to calculate what their overall return is, and that's nothing but the weighted average of their return, return of individual components. What about the weight? So where are these W's coming from? Well, sometimes I will give you the W's, but realistically you will have to calculate the W's. So the W's, it says W's are price times share divided by market value of portfolio. Price times share divided by market value of portfolio. So let's look at an example and let's see what it means, okay? Let's say again, we want to buy 100 shares of each, and we want to know what are the portfolio weights. We want to know how much are we allocating to as a percentage, because again, that's going to have an effect on our portfolio return, okay? So again, we're assuming 100, 100, 100, 100. Let's look at the formula and try to figure out what are we exactly doing over here, okay? So it says WI, or weight of a single security, equal price times share divided by the market value of the portfolio. So here, let's just delete all these numbers so you can tell what we're doing. So here, okay. So we first want to know, well, it says $129 per share, $113 per share, and we're buying 100 shares. So we first want to know how much are we spending, because how much are we spending is going to be that times that, right? Right, okay, so we're doing that. We're doing that for all of them. All of them, we did that, and that. So how much did we spend in total? That's going to be the sum of everything, right? Sum. So this is how much we spend in total, and assuming that this is the only portfolio that we have, this is known as the market value of our portfolio, okay? All right, fine. So now we want to know what is the weight. Our weight doesn't have anything to do with the BMI index, but it is, the stocks are also weighted, but it is, how much did we allocate to each stock as a proportion of the total value of the portfolio, okay? So what is it going to be? Any guesses? So what would be the weight of Facebook?
Just 900 divided by.
All right, so we would say however much we spent on Facebook, and then we would divide it by the total value. Yes or no?
Yes.
All right, so we would do that. And the weights, because we are assuming that we are not borrowing anything, the weights should add to 100%. All right, so we do that for all of them. So what are we doing basically is we're taking that, divide by that, divide that, divide by that. And just by looking at them, you can tell that, well, we probably, the highest weight is for Facebook and the lowest is for Twitter, because again, we're assuming 100 shares of each, and Facebook was the most pricey and Twitter was the least pricey or least expensive, right? So let's just for fun, let's just sum it up. It should be like 100 or 99.9999%. It's not important, but just to recheck your work, you can do that. All right, so we have the weights now. That, and then if we have the set of returns, we can easily calculate what the portfolio return is. So remember, let's say you have 20 securities in your portfolio, okay? What you're not really concerned about is how did a security do on a given day or a given month or a given year. What you are more interested in is how did my portfolio do? Because I have like 30 stocks in there, or 30 securities in there, or 30 assets in there. I want to know how did I do on average. In here, if you think about it, if Twitter did exceedingly bad, but Facebook did exceedingly well, meaning, Facebook return was very high and Twitter was a negative return, that would be kind of offset. Why? Because, the weight for Twitter is much lower than Facebook, right? So you have to think about that. All right, the next step is to calculate portfolio return. So let's try to do this. Let's look at these numbers and let's think about it, and let's think about the equation as well. Okay, so the equation is this. This is the equation, and these are the numbers given to you, let's say, on a test. And you need to calculate again RP. So can you think about what could the steps be? What do we do here? We have a bunch of numbers.
We need to calculate first of all the weighted of each of the.
Okay, so Philippe
Stop.
says the first thing we have to do is calculate the weights, and I agree with him. We first calculate the weights. All right, Priyanka, what do we do next? Once we have the weights, our life becomes a little. Okay, very good. So once we have the weights, we just take that, multiply it by the weight, R, and then we have the RP. So let's do that. So this is what's given to us. What in yellow is what is given to us, okay? So we have 9%, then we have the shares, I just copied them, and then we have the price. So the first thing we do is to calculate again the weights. So as usual, we calculate the total, add them together. We calculate the weight then, the same way we did. And then finally what we do is this. We take the weight, and I'm gonna put an arrow in there. We take the weight and then we multiply them with the return. I'm gonna change the color of the arrow. Alright, so we take this column, return column, weights column, multiply 9 times 0.55, 14 times 0.25, 12 times 0.19, and then add them all together. Does that make sense or not? So let's